In this video, we look at the history of CPI inflation and how far the Fed historically has had to raise its rates to reduce inflation, and what this could suggest for upcoming rate hikes, given that the Fed seems intent on bringing inflation back to its target range of around 2%.
Canadian Mining Report is not a financial advisor, and this video is intended for informational purposes only and does not constitute investment advice. The past performances of the stocks mentioned are not indicative of future results, and the information included is based on publicly available sources and consensus estimates that may or may not be reliable. Canadian Mining Report management or employees may have positions in or marketing relationships with the companies mentioned.
So starting in the 1960s here, the US is still on the gold standard. So CPI inflation is low and the Fed funds rate, which is a rate used for lending overnight between banks and a benchmark rate for the entire economy, stays above it for the whole period. Now after the US went off the gold standard in 1971, we see inflation start to take off, but the Fed keeps the effective rate just ahead of it, and inflation peaks in 1974 at 11% on the first oil crisis and finally declines through to 1976. But the Fed lowers the interest rate quite quickly after this, which leads to inflation taking off again in 1977. And this is exacerbated by the second oil crisis in 1979, and inflation peaks at 14% in 1980. This time around, instead of easing off as inflation cools a bit, the Fed keeps going, raising the rate to 16% or 2% above the peak inflation. Now this finally completely crushes inflation itself by the mid-1980s, but perhaps more importantly, any expectations that inflation will be allowed to get out of control. And it stays low for almost 40 years or until the spike that we've seen in 2022. Starting from 1987 in this slide, we see these low inflation expectations help drive a period that's called the Great Moderation through to 2008, which saw quite low macroeconomic volatility in terms of growth and inflation. In the 1990s, the Fed funds rate stays consistently well above inflation, and then in the early 2000s dips below inflation when rates are lowered after the dot-com boom crashes, and then rates pick up again above inflation just before the 2008 financial crash. Following the 2008 financial crash, the Fed funds rate is slashed to near zero for almost 10 years, and inflation stays higher than it for most of the decade. However, inflation is nowhere near as high as might be expected given such low rates, and only peaks at 3% in 2011 and then eases to near zero. And there are many explanations for this unexpected phenomena that we won't cover here. So the Fed then starts to raise rates again from 2017 and 2018 and just edges above inflation by 2019 before the onset of the global health crisis, which drives the Fed to slash rates back near zero, and along with a massive monetary expansion and stimulus, finally sends inflation soaring to its highest levels in 40 years. This chart shows just how exceptional the situation in 2022 really is. It takes inflation and then subtracts the Fed funds rate, so anytime the number is negative, we can view the Fed as being on top of inflation, and if it's positive, we can view inflation as getting a bit out of control. So we see through the 1960s and early 70s, under the gold standard, the spread is negative with inflation under control. It gets high in the 1970s with the oil shocks, peaking at 3.3%. Then there's the Great Moderation, starting with the plunge in the spread to negative 6.1% by 1982, the volatility in the 2010s after the global financial crisis, and then the spike after the global health crisis to 6.2% in 2022, which is by far the highest spread over the last 6 decades. Now we have to consider how much the Fed can really hike its effective rate while it tries to bring down this historically high spread. So the general rule we see emerging from the data is that US inflation tends to be reversed only when the US Fed funds rate either reaches or exceeds the inflation rate. However, just a hike to about 2.5% already has generated a recession in the US, with growth going negative for the past 2 quarters, as well as a major decline in European GDP growth, and it's caused an 18% decline in the S&P 500. So we doubt that the Fed can really get to the 9% or more that it might need to really crush inflation without driving some serious problems for the markets and the economy. We'd expect that if the Fed funds rate got anywhere near 5%, the ramifications would start to become politically unacceptable, and we would likely see the Fed need to pull back, especially if there's clear signs that inflation is easing, even if it's still not down to the Fed's 2% target. Leave any comments you have on the video below and visit our website www.canadianminingreport.com for more on macroeconomic trends like these that affect metals prices and regular weekly updates on the junior miner sector with a focus on large TSXV listed stocks, our product, the TSXV 50 metal miners, and other long form reports on the sector.